Gentlemen, we're going to get right on to hear from our first speaker this evening, Jordan Eliseo. He's the Chief Economist for ABC Bullion. Prior to taking on this role with ABC, he spent approximately 15 years over in the same hemisphere as Ronnie, both in Sydney and London. He's a co-founder of a boutique precious metal and mining fund, which has been running for a number of years, and he's capitalising on the ongoing bull market in precious metals. Ladies and gentlemen, please welcome Jordan Eliseo.
Thank you, Kerry and Janie, for the very warm introductions and welcome again to everybody here today. The speech that I'm going to be giving, or the presentation that I'm going to be running through today about whether or not Australia is still really the lucky country from an economic perspective, is a continuation of an article that was published in Australian Resource Investor a few months ago regarding, or with the title around, why low interest rates wouldn't save the Australian economy anymore. And there's a few topics that we're going to look at to help explain why that is, or why that's likely to be. We'll start quickly by looking at the actual incredible run we've had in this nation over the past 2 decades, before having a look at some of the debt metrics in this nation and the role of demographics in the ageing population, which is a problem obviously impacting the entire Western world. Then going to have a quick look about whether or not the change of government really changes anything for us. I know a couple of confidence surveys this week have looked great. And then look at the real state of business conditions in this nation, a deeper look at the unemployment rate and what's going on in inflation and cost of living for Australians, and basically then a final comment around savings and the importance of superannuation, both to the Australian economy but obviously also to us as individuals and as investors, before finishing with a few minutes and a bit of a conversation around our Australian housing market, which is obviously very topical for all of us. It's been an incredible place to invest for the last 3 decades, but I'm not sure if anyone saw in today's Australian Financial Review, but an absolutely fantastic analyst by the name of Christopher Joy published an incredible article about the risks going forward in Australian housing, so I'll touch on that as well. So if we start by just looking at the run that we have had since the recession we had to have, to paraphrase Paul Keating back in the early 90s, it really has been an incredible run in Australia. We've basically seen our economy grow for 22 years uninterrupted, from a roughly $400 to $1.5 trillion economic powerhouse, pretty much the envy of the entire developed world, with some of the highest living standards that have obviously accompanied that. So it's safe to say that we've had a very good run. And like all things in life, the good times don't last forever. So after an unprecedented run of growth, it really shouldn't come as a huge surprise to anyone if we go through some pretty difficult times for the foreseeable future. And that run, or the run that we've had for the past 2 decades, has at various points been underpinned by 3 major things. The first, especially in the 1990s, was a huge increase in the nation's productivity, which Treasury estimated accounted for about 90% of all of the national income growth that we enjoyed in the 10 years before the turn of the century. After that started to unwind, or after the magic of that had started to wear off, though, of course, this once-in-a-century commodities boom arrived, which basically pushed up the prices of commodities and saw an unprecedented amount of investment into the mining sector in this nation. And I'm going to touch on both of those in a little bit more detail. Now, what this chart shows is Australia's terms of trade going all the way back to 1960. And it basically measures what we can purchase in terms of imports for a given quantity of exports. So obviously, if whatever we're exporting is going up in price by a lot more than the things that we import, our terms of trade go up significantly. And as you can see, we saw an absolute explosion in this in the sort of previous 15 years as the prices of iron ore, coal, natural gas, and even gold, which is our 4th largest or 3rd largest commodity export, have all increased massively over the last 10 years. But as you can also see from this chart, it looks like the best days of this are behind us. Iron ore is obviously still looking relatively strong right now at around $130, but there are many analysts that are suggesting that the price will fall well north or well south of $100 in the years ahead as this huge glut of supply comes onto the market. China is rebalancing its economy, less fixed capital investment over there. So whilst it's not like our mining sector is necessarily going to collapse or that commodity prices are going to collapse, but the glory days in terms of what this did for our national income and our national prosperity are probably behind us. And it's not only the actual prices that we were receiving for our commodities that helped us in our economy in the last decade, but it was also the amount of money we actually spent investing in mining. This chart's from the Reserve Bank, and it goes all the way back to the 1950s. And you can see before the turn of the century that mining investment only accounted for about 1.5% of GDP as an aggregate. But over the last 10 or 11 years, especially in the last 5 years, it's grown to over 8% of the overall GDP of this nation. And if you actually look at the way that that chart works as well, a staggering 60% of all business investment in this country has come from this one sector alone in the last 5 years. Absolutely unprecedented increase or contribution to GDP. But going forward, we know that a lot of the major miners are starting to unwind and or delay a lot of their expansion or new mine projects because they do realise that there's a lot of supply coming on for the things that they're drilling out of the ground or bringing out of the ground. And what has been a huge contributor to our growth over the last 10 years is going to have some kind of detracting effect going forward. So it's not to say that our mining sector is going to collapse, but the importance of it to our economy, it's not going to give us the same kind of kick along that we've had in the last 5 or 6 years. And the Reserve Bank and the government are well aware of this, and that's why we've seen interest rates get slashed all the way down to 2.5%, with the great hope being that we're going to see a huge construction boom in terms of residential housing, and that basically Australian consumers are going to open their wallets again and start spending, and that those things will take over from the slack of the mining boom unwinding. But unfortunately, this time around, I don't think we're going to be quite so lucky, and that is because debt levels in this nation are actually very elevated, even if you compare us across some of the OECD nations and countries that are more commonly in the news for having debt problems. And obviously, this is pretty topical with the election going on, or with the election just passed, and what people were saying about government debt. And obviously, Labor was saying, look, government debt's not a problem compared to the rest of the world. And I guarantee you the coalition will start saying that very soon as well. And they're absolutely right, because if you look at government debt relative to Italy, Greece, Canada, the United States, it is very, very benign in this country. But if you think about it, government debt is at best only half of the story, because the government's ability to service its debt is entirely reliant on its ability to levy taxes on individuals and businesses in the nation. And of course, the ability of those businesses and individuals in the nation to service the government's debt is in many ways reliant on how much debt we've got on our own balance sheets ourselves. And when you add in financial debt in this nation, non-financial company debt, and the big one, household debt, you can see that the actual amount of money that we owe in Australia is not entirely different to Greece, the United States, even countries like France and Italy, all of these nations which have clearly been in the news a lot lately, having, at best, very serious debt problems, if not debt crises. Now, the point of this is not to suggest that our country's headed the way of our Iberian cousins, but it does say that the idea, or it does suggest that the idea that our country is set to boom again just because interest rates have gone to record lows should be treated with appropriate suspicion. And one other thing when it comes to government debt is, whilst it is low right now in Australia, it's set to worsen quite considerably in the years ahead due to the impact of the ageing population, because demographics are going to hurt us going forward like they are all around the world. What this chart shows is the number of workers per dependent all the way back to 1965 and projected forward for the next 35 years. And what you can see, for the last 50 odd years, we were really in what was a demographic sweet spot in terms of government revenue, because you had proportionally more and more people working and paying taxes in, and less people taking benefits out of the system. But in 2010, that was basically where we hit the inflection point, and going forward, we're going to have less people actually working, so we're going to generate less wealth, pay less in taxes, and we're going to have more and more people actually requiring pension, social security, you name it. This is going to impact every major nation in the developed world. Countries like Japan and that are way ahead of us down the curve on this, and that's why their economies are in even more trouble. But this is going to take, as I say, this is going to pose a huge challenge to government's ability to run a balanced budget, or if in fact pay down debt in the foreseeable future. And ultimately that leads to what happened on Saturday, and I know there'd be a lot of people very, very happy to see the back of the Labor government, and who are probably hoping that hopefully the coalition has the answers. Obviously, a lot of people will remember how strong the Australian economy was under the Howard government, and many of us would like to believe that now that these guys are back in power, everything is going to be okay. But if you really look at what the coalition is saying they're going to do, there's really not much change at all. After spending years of absolutely hammering the Labor government, saying we had a budget emergency, actually now that they're in power, there is no commitment to return to surplus within first term in office, and that's probably fair enough because the economy is struggling. But more importantly, relative to what Labor said they were going to spend money on over the next 3 or 4 years, the coalition's plans are going to save a total sum, if they're met, of $6 billion over 4 years combined. So $1.5 billion a year, which on a $400 billion annual budget is less than half of 1%. So they've obviously advertised themselves as the party of fiscal stability and fiscal responsibility, but really their plans are no different. And what's even more concerning, if you look forward past the forward estimates, and probably by the time we get to the next election, the Australian ran a fantastic piece looking at what some of the costs of the coalition's plans are going to be in that period, either their own plans or plans that they said they'll go along with that Labor has proposed. And if you look across paid parental leave, the National Disability Insurance Scheme, the carbon tax, you name it, we're talking $90 billion of money that's either going to get taxed from you and me, it's going to have to get cut from elsewhere, or it's going to get added to the national credit card. Now, there's obviously a legitimate room for social and political debate about how essential or how good or bad all of these items are, but there's an economic imperative that governments have been ignoring all around the world, and the coalition is no different, and that is pretty simply who is going to pay for this stuff. And with that in mind, it's no surprise that the actual true state of the economy right now and business conditions in this nation are actually very, very poor right now. Australian Industry Group publish a monthly survey into the state of our manufacturing, our services sector and our construction sector. And the way that it basically works, if the index reading that they publish is above 50, it implies that that sector is expanding. If it is below 50, it implies that that sector is contracting. And these are all numbers as at the end of August. They've been published in the last week or so. And you can see that for all three sectors, they are currently contracting, and they have been for a long time. If you look at our services sector, 18 months, manufacturing 26 months, construction 39 months. This is even with interest rates at only 2.5%. And now those headlines are worrisome enough, but if you actually dig a little bit deeper into the survey, our manufacturing sector was compared to 25 global peers. It came last. Our services sector report for August was the worst print and the worst underlying data since the GFC. And our construction sector, yes, there is a bit of a pickup on the housing side, but engineering, particularly due to the unwind of the mining capex boom, is basically falling off a cliff. So we've got really, really serious problems when you look at all of these sectors that the government is hoping are going to pick up and take over from the mining boom. And not surprisingly, it's showing up in the kind of surveys and business condition reports that we see. NAB release a survey once a month that is showing that conditions are basically back heading towards GFC levels. And another company called Dun & Bradstreet, who are the largest credit information bureau in the nation, they publish a report as well, which is where this graph comes from. And if you look at this, it's sales, employment, selling prices, profits, capital investment, you name it. These things are either contracting already or they are trending down. Very, very poor conditions. And if you actually read through some of these things, a couple of points there that I've shown that I think are really important. Only 2 to 3% of businesses plan on spending more or hiring more in the foreseeable future. Over 60% of them see cash flow as a major issue in their operations right now. That is despite the fact, as I say, that interest rates are at record lows and businesses can access credit if they want to. It's just that whoever it is that they're doing business with is finding it hard to pay the bills, and that has a knock-on effect. Probably the most important thing that came out of it, though, certainly in my opinion, though, was that last point which I've bolded and underlined, which was that most viewed RBA cuts as a reason for continued caution rather than investment. And that's really quite profound if you ask me, because that is basically where we've got to as an economy now. People have realised how weak things are and that things are getting a little bit harder. And they realise that the Reserve Bank is slashing rates to record lows because of how difficult things are in the economy right now. So people aren't going, oh, wow, fantastic, interest rates are low, I'm going to go and spend more, I'm going to hire more, I'm going to invest more. People are bunkering down. That's perfectly natural and what you would expect to see after 35 years of spending too much, borrowing too much, and constantly going further into debt. Eventually, it doesn't matter how low interest rates go. And it's starting to show up as well in the unemployment figures. I'm not sure if anyone saw today's unemployment figures. I unfortunately didn't get a chance to update this, but that's the Australian Bureau of Statistics report. Shows that unemployment's at 5.7, now 5.8% after today. You can see a huge trend down from 1993, but most people are predicting that this will go up to 6.25, 6.5% next year. The report today was really shocking. Most people were expecting that we would gain 10,000 jobs in this nation. We actually lost 10,000, and that's even though there were 70,000 people employed temporarily to help with the election. So it was a really, really disappointing number. But of course, this doesn't even really necessarily tell the true story, because the way these numbers are calculated, if you've worked even 1 hour for a week, you're classified as being employed. And a company called Roy Morgan, they publish their own set of unemployment statistics, and if you look at what they're saying where we've been and where we are today, they are putting the unemployment rate already at about 10% in the nation today. And in a consumer poll that was taken which showed these numbers, something like 60% of Australians said that the Roy Morgan number seemed to be a more accurate reflection of the true state of unemployment in this nation. And unfortunately, it's going to get worse in the foreseeable future, because if you look at the number of jobs that are being advertised, ANZ publish this survey every month, you can see that it's basically trending down in terms of year-on-year change and looking not entirely unlike what occurred during the GFC. In WA, for example, the heart of the mining boom and clearly the strongest part of our economy the last few years, job ads are down nearly 50% in the last 12 months. That's how sharp the contraction has been over there. So it's a really, really troubling outlook on the employment front for everyday Australians. And the other thing that's causing huge problem and causing consumer confidence numbers to be relatively weak is the inflationary reality that everyday Australians are facing. Because if you look at the headline inflation number, it looks relatively benign, 2.5% per year. That's the average annual change or average annual increase since the end of the GFC. But if you look at what the things that people really have no choice but to spend money on, childcare and education or insurance and medical, you can see that they've been going up by somewhere between 6 and 8% per annum for the last 5 years. Property rates not too dissimilar, and electricity bills have been going up by nearly 15% per year. So the things that Australians have got really no choice but to spend money on are actually going up by between 3, 4, 5 times the rate of the published inflation number. Now, unfortunately, we don't have a similar company in Australia as far as I'm aware, but there's a company in the UK called Tulay-Pray-Bon who run their own inflation statistic which they measure against the government's. And they've basically estimated, or in their calculations, they show true inflation for British citizens running at least double what the official statistics that are calculated are. Obviously, we've all got our own inflation rate depending on what we spend money on, but it's not entirely unreasonable to suggest that the real inflation rate most Australians are dealing with is probably closer to 4, maybe even a little bit higher than that. And it's why most Australians are saying cost of living is the biggest stress that they've got, because they are dealing with 14% bills or increases in their electricity bills, even if the Reserve Bank and the ABS are saying it's only a 2.5% inflation rate across the country. And of course, this will only get worse if we get what the Reserve Bank and the powers that be are hoping for, which is a much, much lower Australian dollar, because everything that we import is clearly going to get more expensive. So yes, it'll help some of our export-orientated sectors, but everyone will pay in terms of higher prices for things that we import. Last slide that I want to show about the true state of the Australian economy is this one, which is one of my favourite slides, and it's got data from the ABS, the Reserve Bank, and Westpac actually put this together. And what it shows is the huge drawdown, that red line, in our national savings rate from the 1960s and 70s, where we used to save on average about 15, 16% of our income, to basically zero by the start of this century, and then the fact that it's picked back up to 10%. It also shows an absolutely huge increase in gross household debt, or household debt over disposable income. You can see that it's basically doubled, if not gone up by about 2.5 times since the 1980s. That's what's allowed us to improve our standards of living over the last 25 years. It hasn't been how much money we've been earning. This is as an aggregate. Obviously, for each of us as individuals, it could be different. But as an aggregate, that's what's allowed us to consume as much as we have over the past 20, 25 years. It's just that we've simply been borrowing and going even further into debt. What's also really interesting about this chart, though, is that it actually shows the impact of superannuation in this nation. And as you can see, that the grey line here at the bottom, it's only basically just above 0% today. So what that means is, if you think that economists are saying Australia's doing really well because we've got a national savings rate of 10% now, but compulsory super is 9 or 9.25 today. So in terms of the amount of actual free cash flow that everyday Australians have, there's very, very little lying around, because most of us can't spend our super unless we're obviously in retirement. So Most Aussies have very little in the way of free cash flow to spend, even if they wanted to, even if they were feeling more confident about their jobs. It also actually helps to highlight the importance of superannuation, because back in the early 90s, when it was made compulsory, it was only 3% of our salaries, and most people didn't have any money in there anyway. So it was a bit of a non-event in terms of our finances. But wind the clock forward to today, as I say, it's consuming 9% or 9.25% of our salary. That's going up to 12%, and it's already the largest financial asset that most Australians have. And that's why at ABC we've sort of taken an active interest in engaging in the finance and the superannuation community, because we do like to tell our clients to have a, we can't give advice, but have a look at your super. Don't forget you can use it to buy gold. At least make sure it's being invested properly. So when we summarise the true state of the Australian economy, it's pretty safe to say we've had an over-reliance in the last 10, 12 years on one sector, mining, which is declining in terms of the positive impact that it's giving to our country. We've got a significant private sector debt burden. It's far worse than most countries in the OECD. We've got business conditions back near GFC levels, very, very minimal business and consumer confidence and low investment and hiring intentions, and unemployment rates that's on the rise, and higher inflation risk from a potentially falling Australian dollar. And bottom line, Aussies actually don't have much in the way of genuine free cash flow to go out and spend. So they will only be able to do it if they're willing to go even further into debt, which would seem quite unlikely. So with that in mind, it's really, really important that as individuals we make sure our portfolios are constructed properly. We obviously can't change this macro environment that we're in, but we can make sure our money's appropriately positioned to protect ourselves from the risks of Australia either falling into recession or at least seeing much lower growth rates for the foreseeable future. And that leads on pretty nicely to the section about housing that I want to talk about, because obviously with interest rates at record lows and some pretty decent auction clearance rates, especially in Sydney right now, there's a lot of people that are suggesting that Australia is on the verge of yet another house price boom. And we would sort of caution that people should be a little bit hesitant to believe that, and we'll go through why. But before we do, it behoves me to say that as it stands right now, Australia's residential real estate absolutely underpins the wealth of this nation. At roughly $4.86 trillion in value, it's basically 3 times the size of our superannuation pool, 3 times the size of our stock market, essentially 3 times the size of our national economy as it stands. Now, in case everyone thinks, well, so what? Is that a normal figure? Compared to our OECD or our Anglosphere cousins, the answer is no. If you look at, fine, the UK, it's pretty high. It's about 2.82, the ratio between the value of their housing assets and their GDP. But if you look at the United States, which obviously had a huge house price boom, a correction, and now it's going back up again, or at least it has been lately, you can see that their housing market's only worth about $18 trillion. It's barely that much larger than 1 year of annual output. So we have already, as it stands today, an absolutely enormous amount of our wealth and an enormous amount of investment in residential real estate. In terms of the state of the market where it is now and over the last 12 months to June 2013, you can see that national home prices rose about 5%, which is a pretty decent number. But it was quite a disparate set of results. Perth was booming, it went up 11%. Darwin was booming as well, about 8%, and Sydney and New South Wales did really well, up about 6% as well. So they're all great figures, but that's only about where 40–45% of the population lives. So if you look at Queensland, South Australia, Tasmania, etc., even Victoria, most of these states saw house price appreciation at best around the rate of inflation. So hardly booming there for all of those people. And it really shouldn't surprise us that despite rates being at record lows, we're not necessarily going to see a house price boom this time around, because according to this chart, which was produced by AMP Capital, you can actually see that the value of our housing market is considerably more elevated today than what every other major nation, much higher than the value of UK housing, much higher than US. And of course, they've gone through serious corrections. We've never had a serious correction in this nation, which makes some people think that we never will. But that's exactly what those countries were thinking 5 years ago before their housing markets suffered a very, very, very serious fall. So the idea that we're going to see house price growth of 10% per annum year after year after year for the next 5 to 6 years, when valuations are already so extreme relative to incomes and relative to rents, is something that, again, we should be treating with appropriate suspicion. Despite that, though, there are no shortage of people that will tell you that there is nothing but upside ahead for housing, and they'll quote three major reasons. They'll say that overseas buyers are going to snap up property. They'll say low interest rates will spur demand, and they'll claim that we have a housing shortage. Now, if you think about overseas buyers, yes, there has been growth in that market. Yes, there is potential for it to grow further. But the majority of that buying is concentrated in newly built apartments, newly built houses. So it actually adds to the supply side of housing as well. So it's not necessarily the panacea to push prices considerably higher in the future. And not only that, with the risk of a falling Australian dollar, there's a fair chance that many foreign investors will think, you know what, maybe I'll just hold fire for a while because I don't want to go in and buy Australian housing now and potentially take a 15, 20, 30% haircut on the currency, which happened during the GFC, for example. So it will be a source of demand, but the idea that overseas buying alone is going to cause property prices to fly from here is probably not accurate. In terms of that second one, though, the fact that low interest rates will spur demand, obviously low interest rates definitely help improve mortgage serviceability. But I think this chart helps explain why it might not see house prices boom too much more. Because if you look all the way back to the early 1990s, that there is the standard variable mortgage rate. And you can see back then, I'm sure there's many people in the room that would remember, people were having to pay 16, 17% to borrow to buy a house back then. And it's been falling all the way now to the point where you can get a mortgage for well under 6%. Despite that, though, this blue line shows the average amount of money that Australians are having to spend, the percentage of their disposable income, to meet their mortgage repayments. And as you can see, it is considerably higher today with interest rates at all-time lows than what it was 20 years ago when interest rates were nearly 3 times higher. Because Australians have had to go so far into debt to buy housing now that it is costing them more than it ever was, even though interest rates are at all-time low. This is exactly what happened in other countries around the world as well. Eventually, the debt levels just get too high and people don't want to borrow anymore and they can't actually service any more debt, irrespective of what the borrowing cost is, and they don't want to, especially in an environment, as I said before, where there's more risk around unemployment, cost of living pressures are going up and the like. The idea that more and more people will just want to constantly leverage into property is just not accurate. And that's why what we're seeing now in our property market is first home buyers largely in retreat, and the only people that can come in and buy are basically investors, which is not really all that healthy in terms of long-term fundamentals underpinning the market. And the last argument that I want to talk about is this idea that we have a housing shortage, and it's commented on all the time. The National Housing Supply Council a few years ago came out with a report that suggested we needed 85,000 new homes in the nation to meet demand back then. Problem was 60,000 of the homes that they claimed were needed were for people that were either homeless living on the street, homeless living with friends, or marginal residents of caravan parks. Now, it's obviously a social issue that we have a homeless problem in this nation, and that's not something to sneeze at or to pretend doesn't exist. But it's got to be stated that from an economics perspective, those people are not going to be sources of real demand to be able to buy a house. They're not going to be able to go and put 20% down and get a loan from Commonwealth Bank. But what's really interesting is actually how many spare bedrooms we've got in this nation already and how much more effectively we could use our existing housing stock. Because this chart here comes from the Australian Bureau of Statistics. They have a housing and occupancy cost report. This is only a couple of weeks old. And what it shows is that over 75% of Australians report that they have at least one spare bedroom in their homes. Now, if you think that there's 8 million households in the country, that means we've probably got somewhere in the vicinity of 5 to 6 million spare bedrooms already in this country without having to build one extra house. Now, of course, that doesn't mean we're just all going to start letting random people move into our houses so we can use them more effectively. But what it does mean is that as times get tougher, you're going to have these kind of situations. You're going to have maybe a couple of girls sharing a 3-bedroom apartment on the North Shore saying, maybe we can have another flatmate, that'll save us some rental costs. You're going to have young families say, you know what, we can only afford to have one child, so maybe we only need a 2-bedroom house rather than a 3-bedroom house. You're going to have university students and young professionals say, maybe I can live with mum and dad a little bit longer so I can save some money. Janie's smiling at me going, I hope my kids don't stay any longer than they have to. And whilst that's obviously just a theory that I'm espousing, if you actually look at what's happened in the last census data, it's exactly what happened. For the first time in 100 years of us doing censuses in this nation, the number of people living in each house actually went up because people are finding it harder to get ahead. It doesn't show up hugely. It's not a huge change, but that is a 100-year trend that came to an end. Up until then, we had constantly had less and less people living in each and every house. But now, in the last 5 years, since basically the GFC hit, people are finding it harder to get ahead, and they're going, you know what, maybe we don't need all these spare bedrooms, maybe we don't need these huge houses, we can use our existing stock more effectively. And that is going to be a headwind for house prices going forward. I'm very confident that number will be even higher another 5 years from now when we do our next census. And the last thing that I think should make people be a bit wary about house prices going much higher for the foreseeable future is the ageing population again. And this is something that is hardly ever talked about when it comes to home prices, but the actual finances of the baby boomers as they enter retirement. And a little bit of information to put this in context, there's basically 5.5 million baby boomers in the nation. They account for roughly 25% of the population. Despite that, they own half the nation's housing stock as it stands today, and it represents basically 1/2 of all of their net worth. At least half are planning to move and downsize in retirement, and at least a quarter are planning to sell. And according to some analysis done by ASFA, Australian Association of Super Funds, 86% of them are either unprepared or are only somewhat prepared for retirement. Now, I got these figures at the end of 2012, and it shows that the average couple between the age of 61 and 64, if you look at the males, they have about $200,000 in super, and the females tend to have about $112,000, so about $310,000 all up. Let's round it up to $325 just to be nice. We also know that it's going to take them, or it's going to cost roughly $55,000 a year to live a comfortable retirement. And if you go through all the surveys, most baby boomers are planning on living very, very nicely in retirement. So that's a pretty conservative figure in terms of what they'll probably want to spend. Now, if you were to take $325,000 and invest it in a diversified growth fund and it was going to return 8% like all of the big fund managers will tell you they can do for you, not as good as 9%, which gold's done over the last 40 years, but anyway. Even if you were to do that, your money would run out somewhere between year 7 and year 8, meaning this couple is probably going to run out of money, or a couple like this will run out of money between somewhere in their late 60s or early 70s, depending on when they retire, well short of when they're most likely to live to. And this is, as I say, this is the average Australian, so it's hugely skewed by very, very wealthy Australians. Most Aussies are in nowhere near this good a financial situation, or most boomers aren't, as they approach retirement. So the bottom line is a lot of them are going to need to sell their homes to basically pay for their expenses in retirement. And what that's going to do is provide a huge headwind to house prices, and it's something that has occurred all over the world. Basically, as the population has aged, and you can see that by these lines here, which are falling, house prices have basically reached their peak and started to correct, because you essentially have, it's just basic law of supply and demand, proportionally more and more people looking to sell and less people that are willing to buy. Very, very simple and easy to understand, and it will be a headwind for Aussie housing going forward. So the idea that the housing market is set to take another boom and it's a fantastic place to invest, I'm absolutely with Chris Joy on this. I think people should be very cautious. You need to spend a lot of money to do it. There's a lot of costs. There's a lot of leverage involved as well. So I think it's something that people should be appropriately cautious of. And as a final sort of slide and a final thought, and I think a good segue to Ronald's presentation about gold, is over the last 130 years, there have been 3 major cycles between the price of gold, or the value of gold, and the value of Australian housing. And you can see that from this chart here. This goes all the way back to 1880. And what it shows is that at the peak of a gold bull market relative to the housing market, you've tended to be able to buy a house in Sydney for about 100 ounces of gold. Now, 100 ounces of gold today will cost you about $150,000. That'll only get you the 20% deposit you need on a Sydney home right now, because that's going to cost you about $700,000 at today's value. Now, none of us can be absolutely sure that history is going to repeat itself, but I fully expect to see that ratio narrow significantly in the coming years ahead. So for me personally, I will definitely be trying to just acquire my 100 ounces of gold, because I feel very strongly that it may well end up buying me an entire home in the years to come. So thank you very much for your time, and I think, Kerry, you're coming back onto the stage now. Cheers.
Thank you very much, Jordan. Thanks, George.